Welcome to the Fin Talks, a chat with Finance Malta. Today we have Meli from the MFSA. Ian, may I invite you to introduce yourself?
I'm Meli. I'm one of the deputy heads within the Securities and Market Supervision function of the Malta Financial Services Authority. I've been with the authority for 10 years, and I am responsible for the supervision of collective investment schemes, fund managers, and investment firms.
Great, thank you. So we'll start off with the questions. Can you talk us through how the MFSA approaches the supervision of collective investment schemes and their service providers?
So, through supervision, the MFSA ensures that it protects the interests of investors of financial services. So the Securities and Market Supervision, as I mentioned earlier, is responsible for the supervision within the asset management sector. It currently supervises 590 collective investment schemes, 58 fund managers, 12 custodians, and 20 recognized fund administrators. The total assets under management that of the local asset management industry is currently 12.5 billion of assets. So at the outset, the deliverance of high quality risk-based supervision remains a priority for the MFSA. This is achieved through a supervisory cycle involving on-site inspections, off-site desk-based reviews, and enhanced supervision. The outcome of the risk-based supervisory model provides indications on the target visit population and the correlated frequency. On-site inspections can be segregated into broad scope and focused inspections. The case of broad scope inspections, the focus would typically be on governance, risk, and compliance. And in the case of focused inspections, teams are chosen depending on the MFSA supervisory priorities, ESMA priorities, as well as other supervisory matters which the MFSA would be privy to, resulting from previous years. Once these priorities are determined and the teams are selected, the MFSA determines the population of license holders that should be visited. So in determining the population, a risk-based approach is adopted. The information that determines the selection of the population typically includes the results of the risk scoring of the risk-based models that the function operates, information that may be received from external third parties or other national competent authorities, information from previous on-site inspections and other findings which have not been resolved or which are ongoing, and typically the nature, scale, and complexity of a license holder. License holders who have an extensive market presence would typically be targeted at more frequent intervals towards visits. The modus operandi of an inspection may vary depending on the scope of the inspection. The scope can be broad scope, as I mentioned, typically governance, risk, and compliance, or focused. And we also carry out surprise inspections.
Okay.
Surprise inspections typically would arise when there is a case of enhanced supervision and we visit the license holder unannounced. The inspection process is subdivided into three categories. The pre-inspection stage, whereby as an authority we inform the license holder of the visit schedule, the details of the visit, who will be leading the visit, and typically we also request a set of documentation that needs to be submitted to the MFSA through the license holder portal for review before the visit. Once we send that pre-notification and the documentation is received by the authority, from then on we start our review process. We review the documentation, which would typically include policies, board minutes, investment committee minutes, perhaps internal audit reports, and the review starts at that stage. Once the review is completed, a pre-inspection report is drawn up, and that would typically serve as a guideline for the inspectors to carry out the visit accordingly. Together with the pre-inspection report, we also have a set of checklists, which are used depending on the nature and scope of that visit, and that would typically conclude the pre-inspection process. From then on, the next step of the cycle would be the inspection stage. It can take various forms, but the most commonly used form is through interviewing, whereby we start by requesting license holders to provide us with a presentation of the operations of the company, the business models, and an overview of how the company operates in practice. From then on, we will have our scheduled agenda of meetings and function holders who we intend to actually interview.
Okay.
From then on, we'll start the interviews. We can ask for additional documentation, and typically the visit is close to a concluding meeting. From then on, the post-inspection process kicks in. This would involve analysis of any documentation which has been retrieved in the ongoing inspection process, as well as any other analysis which needs to be conducted following the inspection stage. From then on, the inspectors draft a post-visit report. If necessary, other meetings and interactions are held with the license holders, and if there aren't any other pending matters, the report is sent to license holders. If there are any pending matters, the license holder would be requested to provide feedback as necessary.
Right.
In the event that there are major findings, the license holder would be placed under enhanced monitoring, whereby more focus on supervision is placed on that specific license holder. The license holder could be subject to a remediation plan, and if those remedies and the MFSA is not satisfied with the implementation of the changes required and the recommendations made in the post inspection report, then it could resort as a supervisory function to the referral process for enforcement referrals. As I mentioned earlier, there's also off-site supervision, which is typically desk-based reviews of documentation received throughout the year. These would typically include returns, financial statements, financial documentation, Annex 4 reporting. These are reviewed. We operate by way of a relationship allocations, whereby our staff are assigned a portfolio of license holders,
Right.
and they would be the main contact point for that license holder, and they would interact with that license holder accordingly. As I mentioned earlier, we have also in our supervisory cycle the possibility of enhanced supervision. If we determine that there are a number of issues within a license holder, or as the license holder merits a closer look, or if there are any red flags, we would focus more resources on that license holder.
Right. Okay. Thank you very much. And specifically for 2021, what are the supervisory priorities of the MFSA?
In the asset management sector, the supervisory priorities will be a common supervisory action on costs and fees. This has been an ASMA work stream and has been launched by the European Securities and Markets Authority for 2021. The MFSA will be tackling this common supervisory action by way of a questionnaire, and the questionnaire will be targeting UCITS management companies and self-managed UCITS, and from the answers of the questionnaire, the MFSA will also be targeting, through on-site inspections, additional clarifications and verifications on how UCITS are charging costs to investors and the adequacy of costs and fees. Also, we are currently conducting inspections with respect to outsourcing of key functions. This will be carried out during the first half of the year. Outsourcing is very important. Typically, the asset management sector operates by way of outsourcing either portfolio management or risk management, and there are other key functions such as compliance and internal audit which may be outsourced, and it's important as one of the key risk areas in the sector that we ensure that the outsourcing activities are being monitored accordingly. If I can briefly touch on liquidity risk management, during 2020, the MFSA was part of another common supervisory action
This
launched,
was my next question.
launched by ESMA. This followed preliminary work undertaken in 2019, and following that work, we've issued another questionnaire and we've undertaken dedicated on-site inspections on this area.
Okay. So what was the outcome of the common supervisory action review on liquidity?
So the scope of this common supervisory action was to address current or potential mismatches between the asset and liability side of the fund, that is, dealings and the liquidity position and liquidity ladders of the portfolio of the fund, both under current and stress scenarios.
Okay.
So it's important in the sense that liquidity risk management can contribute to financial instability and may raise concerns with respect to investor protection and the orderly functioning of the markets. In terms of findings, we've analyzed liquidity risk management policies and procedures, and whilst we haven't identified any major issues in the area, our review on UCITS managers suggested that such policies can be improved to ensure that they comprehensively reflect the investment strategies of the funds under management, so they would be more focused and tailor-made to the specific strategy of that fund.
Right.
Another
So did you see some sway in their implementation of the strategy?
What we've seen is that these policies were quite generic,
Right.
and
I see. Okay.
we would like to see that these are more tailor-made
Yes, that
and
they're more
focused
specific.
towards the strategy of that specific fund,
Okay.
in the sense that one fund can have a different strategy from the other. Another area which we've seen is pre-investment liquidity analysis and forecasts. Although it's not expected that with respect to listed securities, there are detailed checks with respect to pre-investment liquidity. It is expected that these are undertaken with respect to unlisted securities, but in the area of listed securities, one has to pay attention on the actual market cap and volume of trading. If there are securities which are not traded but are listed, then the fund manager would have to undertake additional liquidity pre-investment checks on that asset as well.
Okay, very good. And you mentioned outsourcing. What are the functions that fund managers can outsource, and what are the regulators' expectations in this regard in terms of what they report and how that value chain works?
So we're cognizant that outsourcing may increase operational efficiency and that this will eventually raise the bar of key functions within a license holder. Outsourcing can also enable a firm to benefit from enhanced business processes and the additional expertise that an outsourced function can bring to the company. However, outsourcing of key functions does not exonerate responsibilities on the side of the investment manager, and it brings about risks that, if they are not managed, can have repercussions on that license holder. So outsourcing could possibly lead to over-reliance on service providers, so the license holder and the board of directors need to ensure that they have a robust setup to monitor and oversee any outsourced functions. This should be done in an effective manner and to ensure that the level of the expected standard of the outsourced function is kept. There could also be a risk of over-reliance on outsourced entities, but the license holder still needs to have contingency planning associated with this risk, in the sense that it should have contingency plans in the event that one of the outsourced functions may experience difficulties in its operations. Although a license holder can and is allowed to outsource certain functions, such as portfolio or risk management, the core decision making needs to remain within that license holder. Delegation and outsourcing of activities can take place, they're allowed, but a license holder cannot end up as a letterbox entity.
And ultimately, the license holder retains responsibility for those functions, even though they delegate the functions to an outsourced provider. Is that right?
Yes, definitely. In fact, the license holder would be expected to exercise monitoring both prior to engaging a service provider and also on an ongoing basis. And ultimately, if something goes wrong with an outsourced function, the license holder, and typically in the local context, the board of directors, would be responsible for any issues that may arise as a result of the operations or the malfunction of an outsourced entity.
Right, okay. And how does that relate to substance rules?
No. In terms of substance, it's expected that our license holders retain a core element of local presence, and that although the regulations, particularly the AFMD, allows the delegation of portfolio or risk management, nevertheless, one of them and part of the operations still need to be retained locally, and the company would still need to have its local employees.
Okay, very good, thank you. And can you outline the way the notified AIF and the professional investor fund regimes are supervised and whether they provide adequate investor protection?
So the regulatory framework with respect to collective investment schemes in Malta has adopted a flexible approach, in the sense that it has its alternative investor funds, the UCITS funds, and also the homegrown professional investor fund regime. The professional investor fund regime is very appealable to those small startup companies typically investing in private equity, and by way of using this type of setup, these license holders would benefit from additional economies of scale, as these would not be required to fully comply with the Alternative Investment Fund Managers Directive, the AFMD. However, these are still authorized professional investor funds, and they still are supervised on an ongoing basis. So there's also a level of regulatory framework embedded in this professional investor fund regime. In 2016, the MFSA also launched the notified AIF regime. The notified AIF regime, the main advantage of this regime is that it is is subject to a fast tracking registration process, while relying on the regulatory status of the manager of that AIF. Typically, once a risk management policy is submitted and pre-notified to the MFSA is required to issue a registration of an AIF within a 10 working day time frame, obviously considering that the application is submitted in full. In terms of supervision of the notified AIF, whilst the MFSA does not supervise the notified AIF directly, as it is subject to a registration, reliance is put on the Alternative Investment Fund Manager, whereby we monitor the governance and control functions within the AIFM, and we also monitor the financial position of that Alternative Investment Fund Manager from a prudential perspective, as well as other areas like the compliance and AML CFT functions of that fund manager. An AIF can be set up in various forms. It can be either closed-ended or open-ended. It can have a number of investment strategies, and we are, as an authority, currently going through a process whereby we're determining whether it would be appropriate to extend the investment strategies allowed in terms of the current NAIF regime.
Which investment strategies would be included, if you're able to share?
Currently, we're also considering whether the NAIF could invest in portfolios of loans. However, these discussions are still ongoing, and obviously there's no commitment at this current stage. However, it is also important to note that we have experienced an increase in the registration of notified AIFs, and 11% of the current fund population today is in the form of an AIF.
Thank you very much. That's all my questions today. This was Meli from the MFSA.
Thank you for your time.